Hey there, Austin Meyer, coming at you from X-Force PC, Mike's Playhouse, here with Mike Brown.
I'm here, yes.
I'm here, yes. And so, Mike, the other day I was giving a friend a test drive in my Tesla. And of course, as soon as we were done with the test drive, he says what everybody always says, which is, oh my God, that was so amazing. How do I buy Tesla stock, right? That's always what they say. It was amazing. How do I buy Tesla stock? And my immediate reaction was, whoa, 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 whoa. I'm not going to automatically say, buy Tesla stock, when it's not so clear to me whether or not that stock is already appreciated as much as it's going to appreciate. Why don't we go through about 6 or 7 different ways to supposedly invest money, and let's look at how they actually return. And we're going to see what is the really smart way to invest money. So as we see, we got a graph here. This is dollars and this is time. Now notice this is dollars. This isn't value. This is United States American dollars. So I'm going to draw a little graph here, okay? Let's say we invest a certain amount of money, and I'm trying to draw a nice thick line here. And this absolutely is a line that does 0% return. What is that?
That is cash.
That is cash. Okay, what if you want to make an investment, a nice safe investment that your parents probably told you, oh, you should make this investment in the blue line.
A savings account.
Exactly. That
is a smart thing to do. You must save. It's in the name.
Yes, I'm going to call it a savings account. And what is the interest rate that you get from a savings account?
Well, I figured it was about what inflation would be, 2 or 3%, but obviously it's not.
It is actually
by your little grin there.
0.01%. And inflation is 2%, so you're losing money. If you put money in a savings account, you are losing money. So savings account, you still lose money because take 2% out of this for inflation, and savings account loses money. All right, it's possible to do a little better than a savings account. What is the investment that can do a little bit better than a savings account if you agree to let them hold your money for a long time? What is it?
A CD or a certificate of deposit.
Right, a CD. And what is the interest rate that you get from CDs?
Well, before this conversation, I would have thought 3 or 4%.
But in actuality?
It's like point something.
0.17%.
Or 17 times better than a savings
So,
account.
yeah, but inflation, remember, is 2%. You lose money with the CD. And when you do this CD, you are guaranteeing that you cannot get to your money for like, a year or 2 years or 3 years. Otherwise, substantial penalties apply. Remember that substantial penalties apply if you try and get to your own money. The CD is absolute garbage. It's garbage. You're losing money hand over fist due to inflation. Let's look at another one. Speaking of inflation, what do you think? Now, good luck in me keeping a nice thick line we can always see. What do you think this green line is? And I'll give you a hint. Inflation runs about 2%, okay, over the long run. So I'm going to guess that this investment will do about 2% in the long run. That's my guess. Long run, this investment might do about 2%. In other words, this is an investment that is designed to guard against inflation. And what investment is this?
Well, from an earlier take, I happen to know this is Bitcoin.
Exactly, this is Bitcoin.
We're going to do a separate video on Bitcoin, but I don't call Bitcoin an investment because it doesn't go up or down for any reasonable rhyme or reason. It's always some hot news take or whatever.
Right. I got a different idea.
And it's not an investment, it's a currency.
Right, just currency trading. Right. Here's why Bitcoin is not an investment. When I make an investment, I give money to a company that I believe is then, and this is when I'm lucky enough to do venture capital early investor investment, which I've done and been very successful with. I put money in, I watch the company spend the money, combine it with work and sweat and ingenuity, and return like way more than I put in. In other words, a real investment is when you put money into a thing, let somebody combine that money with ingenuity and sweat, and return something better than you started with. That's an investment. The design of Bitcoin, what it's designed for, is to eliminate inflation. And so in theory, it'll just go with inflation. But what happens in practice, of course, is
wild fluctuations.
Wild fluctuations. Every time Elon makes a tweet about Bitcoin, oh, it's to the moon. Oh, no, it's crashing. And so it winds up all over the place and not really quite meeting the mission that it was designed for, which is simply to protect you from inflation. All right, so that's Bitcoin. Now let's do another one. The next, and every time we're increasing the risk and increasing the return. Every one of these involves more risk and more return. And remember, of course, it's more risk and more return, because if you're going to get a higher return, you have to pay for it with higher risk. That's life, is what that is. That's life. Okay, so what am I drawing? What is that?
That looks like the stock market overall.
That's correct. Or what is a stock? Let's say you buy a stock. Here, I'll draw another stock.
A successful stock.
There's another stock. Oh, there's another stock. These are stocks over time. A lot of stocks. Some do better, some do worse. What do stock markets do over time?
Was it 12%?
No, it's actually better than that. Over a long period of time,
15%.
Stocks do about 15% over the long run. When did the stock market first start? When did we have our first stock market in the United States?
It was around 1900, wasn't it?
1790.
Wow.
The Philadelphia Exchange, 1790. How do you know when to buy a stock?
Well, you have to believe in the future success of that company or other people's perception of their future success.
Wrong. Wrong. You forgot to consider that is already baked into the price you're paying now. If everybody thinks the company is going to be successful in the future, then the stock is already expensive now. You see? So the stock price now is based on what people think the company will be worth in the future. The stock price in the future is based on what people in the future think the company will be worth in the future. In other words, the stock price is not based on what the company is going to be worth. It's based on what people of the future think the company will be worth in the future, minus what people of today think the company will be worth in the future. You see? Because remember, you're not just going to sell the stock later. You got to buy it now. Okay, so let's say you buy stock in a company that's not doing very well. Then the company does better over time and you sell the stock. Is that a way to make money in the stock market?
Yeah, sure.
No, because when you bought the stock, people might already have predicted the success of the company. And in fact, they might have over-predicted the success of the company. So you may have bought the stock at too high a price. And so let's say you buy a stock in 2000, but people are convinced that company is going to make $10 billion. Then, as it turns out, now it only looks like they're going to make $9 billion, not $10 billion. The stock goes down 10%, even though the company has gone from $0 to $9 billion in revenue. In other words, the stock price is not connected to the actual value of the company. The stock price is connected to what people think the company will make in the future. But you're going to pay that when you buy the stock, whether you like it or not. It's not something you just realize in the back end when you sell it.
So you're saying you have to be even more future looking.
Exactly. You have to be even more future looking than someone else. And guess what? Somebody else is going to be more future looking than you are when you're already more future looking. The whole thing is just a vicious circle. And so nobody can get ahead of anybody else because everybody's trying to get ahead of the person in front of them. And and someone else is trying to get ahead of that person. And the whole thing is such a snowball that you can't tell what's going to happen anymore because everybody's trying to predict. And at that point, it becomes like trying to pick lottery numbers. It just becomes random noise because nobody's making their decisions based on data. everybody's making decisions based on what they think everybody else is going to make decisions on, which is based on what everybody else is going to make decisions on, which is what they think everybody else is going to make decisions on. And you're so far removed from reality that there's no rational stock price anymore.
What's frustrating is when you buy a stock and the company is doing really well and has a great product, but the stock doesn't go up.
And sometimes it even goes down. And the reason that happens is because when you bought the stock in this company, everybody was expecting it to do so super well that the stock was already high when you got it. And so you lost your ability to make a return, even though you watched the company go up and you still didn't make money. And here's the quote on that. The stock market can remain irrational longer than you can remain solvent. So it's basically impossible to pick the right stock because the future value of the stock is already baked into the stock price when you make the purchase. I think it's the Wall Street Journal. Yeah, every year they have a contest where they have users pick stocks. Okay, just Wall Street Journal readers. So I want this stock, I want that stock. And they have experts that charge a lot of fees pick stocks. Who does better, do you think? Just the average Joe Blow users or the experts?
They do the same.
Yeah, they basically do the same. One year, they had a cat named Orlando. Orlando, the British tabby cat, picked stocks. And the way that Orlando, the British tabby cat, picked the stocks is they put a thing on the floor with stock IDs, on every, little tile in the floor, and they let the cat, throw his little mousy toy, and wherever the mousy toy landed, that was the stock you bought. Yeah, Orlando beat Justin Stewart of Wealth Management's 7 Investment, beat Paul Kavanaugh of Stockbrokers Killick & Company, and beat Andy Bro of the Schroders Fund. What they did is try and use all this analysis, whoa, what's the ultimate stock based on all the analysis? But all the analysis they were doing was the same analysis that other people were doing. So other people are going to beat them to it. You might say, oh, well, maybe they could be before those other people. Yeah, well, then someone else is going to be before them. And then someone else is going to be before them until nobody's making decisions anymore on what a company is worth. They're all making decisions on what they think somebody will think a company might be worth in the future. The whole thing is just a big circular argument. And so Orlando won the bet. So what I'm really saying is you cannot pick stocks because the stocks don't track the value of the company. Stocks track perceptions of what other people perceive, someone else will perceive, that someone else will perceive, and so on ad infinitum. So, how do we protect ourselves from the fact that we simply cannot pick a good stock? If you don't know how to pick stocks, and you'd be wise to admit that you can't, what is the investment you should make?
Get a cat?
That would not be a bad start.
But I would say mutual funds.
Exactly, mutual funds. So I'm going to draw a line here. Now, what is the mutual fund line going to look like if you buy mutual funds?
I would say because of their fees, they charge probably a little worse than the stock market.
And does it go up and down like crazy?
It'll be a straighter line because it's made up of multiple stocks.
Exactly. A mutual fund will be less volatile. A mutual fund is just a collection of stocks. It's some fund manager that says, oh, I know what stocks to buy. Kathy Wood is the person a lot of people are talking about right now. This says, I know what stocks to buy. And so she has her funds and she collects a bunch of stocks. And we are saved from some of this volatility because when you buy a mutual fund, you're buying a collection of stocks. And what do these fund managers charge for their time?
I would guess about 1% maybe.
About 1.5% per year. So every year your dollar turns into 98.5 cents just for having the fund manager do it. And are the fund managers magic? Can they pick better stocks than tabby cats?
Well, that's what they want you to believe.
And can they?
Apparently they can't.
They cannot. And so you're actually going to find that your mutual funds might, and it depends on what funds, I can give you pretty much any number I want here depending on what mutual funds I look at and what time range I'm looking at. So if anybody Googles this, you'll be able to find different numbers in this based on the time range and the funds you choose. But the mutual fund managers charge about 1.5%. They buy a collection of stocks. They cannot choose stocks any better than a tabby cat. Therefore, the mutual funds in the long run are going to do worse than a random collection of stocks. Why would you buy a mutual fund when it's just an average of the stocks?
I don't have to think.
You don't have to think. That's a good reason. And if you don't have to think, how does that change your investment strategy? Let's say you bought a stock, all right? You hear from me, oh, Tesla's amazing, Tesla to the moon, right? I come screeching up your parking lot in my Tesla, there's burned rubber and a trail of cop cars behind me and, all this excitement, incredible speed, and, it's this amazing car, Tesla to the moon. I'm like, Mike, Tesla's awesome. You gotta buy Tesla stock. And of course, I'm telling you that right here, right? You gotta buy Tesla. It's awesome. The car is amazing. You're like, okay, I'll buy Tesla stock. And then the next day, oh, I don't know, Elon sends out a politically incorrect tweet, right? Or the next day, one person crashes a Tesla, but the entire United States media is like, oh, look, a Tesla crash. And then Tesla stock goes down. What are you going to do when you see the stock deteriorating right after I gave you this stock tip? What are you going to do?
Well, an ignorant person would immediately sell it and lose, 10, 20%. I personally would realize what goes down is probably going to come back up.
I don't believe you. I think you would sell it when it went down.
Okay.
What the vast majority of people do is they hear the stock is amazing and they buy it. The stock goes down, as it will. They get scared. They say, oh, this is a bad stock, and they sell it. And there's an evolutionary reason this happens, and here's what it is. When we evolved, we learned to say, hey, if there's a lot of fish in that stream, I'm going to go fish there. And if it's a dead section of the stream, no fish are there, I'm not going to go fish there. We've learned evolutionarily to go where the fish are, go where the action is. And when you look at a stock, when it's high, our brain is telling us there's a lot of fish. There's a lot of fish in this part of the stream, I got to get in it. And then when it goes down, our brains tell us, oh, there's no fish in this stream. This stream is dying, I got to get out. The way our brains have evolved over time tells us, buy the stock when it's high and sell the stock when it's low. This is why stocks don't work for so many people. So, when you buy a mutual fund, what's the difference?
There's no panic.
When I personally have bought stocks, I've seen the stock go down, like, oh no, it's going down, I gotta get out, and I've sold. When I bought mutual funds, and I've seen the fund going down, I said, it's gonna go up over time with the market, I'll just leave it. But we are paying a price for this, and that price is about 1.5% in annual fees. And it annoys me just a little bit that we're paying 1.5% of our income for life to somebody to pick stocks that has a demonstrated history of being no better than our cat. Is there a way that we can have our cake and eat it too? Can we get the thing that changes in a less dramatic fashion, tends to build in the long run over time, and doesn't cause us to want to eject every time there's a drop, but doesn't hit us with this annoying fee?
Well, what
is
if you
there a
could
solution?
just bet on or invest in or whatever you want to call it, the entire stock market?
Exactly.
Because the entire stock market will go up 15%.
I don't know of anything that does that, but we can get close. I'm going to introduce you to what I do my investment in these days. QQQ. This is an index fund, and here's what an index fund is. An index fund has almost no fees associated with it. It's not this 1.5% fee. It's just some guys that say, all right, we're going to buy a whole bunch of stocks. We're just going to buy the top stocks in the NASDAQ, or the top stocks in the in the stock market, the top 500, called the S&P 500. We're just going to buy a bunch of stocks. We decide from math what they're going to be, and we're not going to try and charge some exorbitant fee to be the perfect stock pickers. So what will the line look like if we have one of these funds? It's a whole bunch of stocks with almost no fee. What's it going to look like compared to these lines?
A little bit flatter than the mutual fund.
And we're above or below?
It's going to be at about 15%, I would think.
Exactly. This is the so-called index fund. It tracks a large number of stocks. Can you guess what the fees are for an index fund?
Well, if it's 1.5 for a mutual fund, I'm going to guess it's like maybe 0.5%.
You're off by a factor of 10. 0.05%. It's 0.1/10%. And so your fees are next to nothing. And so you realize the gain of the stock market over time and how much stocks go up over time, but with basically no fees. Because the people aren't telling you that they're better than they are. You're not paying someone to tell you they're better than they are. So let's play a psychological game. Let's say you're a normal person. Stop being Mike Brown for a second. You're a normal person. You buy the stock here because I told you. And you're like excited about Tesla. And you buy Tesla because you're excited about it because you see what my car can do. It goes down. What does a normal person do?
Oh my gosh, it might continue to go down. I'm going to sell it.
And they sell and they lose money. Now let's say you're a normal person. And let's say you buy here. I'm like, hey, Mike, you got to get QQQ or any other index fund, Google index funds. Then over time, yeah, it goes down some. What are you going to do?
I'm going to look at it and probably go, oh, this thing isn't really going up, but it hasn't gone down much. So, it's too much trouble to try to get out of it. I'm just going to stick with it.
I'm going to stick with it for a different reason. It's not that it hasn't gone down that much. It's that we have 200 years of history telling us that the stock market goes up over time. The blue line here is the stock market over 120 years. So let's say that you're in the roaring 20s and it goes up, and then the crash of 1930 happens and it goes down. And this is like the worst financial event in the history of our country, I guess.
It doesn't look that bad on there, though.
Because
it continues to go up.
It's nothing compared to the gains. The worst financial event in the history of the nation is nothing compared to what happens in the long run. And so my one simple trick to making money in the stock market is to buy an index fund and then take a class in cooking to eat healthier.
So you'll
Spend
live
time with your family.
so that you'll see more gains.
So you'll live longer to see more gains. Spend time with your family. Go out for a walk. Live your life. Don't sit there staring at a stock ready to sell as soon as it goes down. Multiple studies have shown that the more activity you have in your stock portfolio, the less money you make. Because you keep falling victim to the buy high, sell low scam. It's doing great, I gotta buy. Oh no, it's doing terrible, I gotta sell. So that's it. Get an index fund, Google index funds, avoid the fees, buy the fund, QQQ is the one I do myself, buy the fund, don't touch anything, wait, let it build over time. That's a trick to making money in the stock market. And I've never lost money doing it. Can you find any reason that I'm wrong or that you would invest differently than that?
Only if I enjoyed the roller coaster ride.
Yeah.
If you enjoy the roller coaster ride of the stock market, then sure. You like to sit there with 5 monitors in front of you and monitor it and day trade and all that, sure.
But if you have 5 monitors, somebody else has 6.
Right. But no, it looks like the best way is the index fund.
Yep.